I wanted to do three things for you in this brief presentation. The first is to set some context from my point of view. Secondly, to say something about climate change capital, because in a way our business is emblematic of the opportunities that do exist for investors, and we are living every day what we preach. And I think you'll see in what we're doing some interesting strategies for investors. And thirdly, to conclude that for the industry as a whole, confronting this very daunting challenge of climate change and finding the opportunities to reduce risk and derive good value from investment is part of a movement to create a new form of wealth. And that wealth we've described at Climate Change Capital, to the point where I'm glad to say we've managed to trademark it, is creating wealth worth having. So once you understand the climate change issue and the level of threat, in some sense the existential threat of climate change, it's imperative that we rethink not only how we create wealth, but what wealth is for and how it can be most closely allied to the public interest of dealing with this problem. So firstly, some context. I can start off by picking up the parts per million theme of our last session. It's not surprising to me that there was significant reaction to Professor Garner's target setting this last week, because the 550 parts per million number is the wrong number. It's the wrong number by any reasonable account of the state of the science, not just that which forms a consensus of the Intergovernmental Panel on Climate Change, but the latest consensus that's forming around very different numbers. One thing to point out is that because of the multilateral process that forms this consensus, and because consensus is very easy to interrupt, and because there is a political element to the formation of an Intergovernmental Panel report, even one that's based upon science, the consensus of 450 parts per million as the right number to aim at was out of date almost the moment it was published. And the front end, the frontier of the scientific movement dealing with climate change picks numbers that are closer to 350. 350. I had dinner this last week with Jim Hansen, Dr. Hansen, the great NASA scientist, one of the best advocates for action in the scientific community on climate change. And he thinks that 350 is in itself a risky target, that probably, because of what they're now finding out about the real dramatic change in both poles, especially with the Arctic ice and the ice sheet movements, is that we need to find a target that is below 350, but 350 will do, he thinks. So 550 is the wrong number. Secondly, what's good about the domestic regime that you're contemplating here is that it does have long-term targets, and there will be a good investment framework once that law is in place. What you can learn from us in Europe, a few years ahead of you, is that the initial allocation process is absolutely vital, and that investors need to see that long-term price signal before they commit large amounts of capital, and we need large amounts of capital, into alternative energy, into fuel switches, into clean technology, and the various ways in which opportunity can be derived from the absolute necessity of dealing with this problem. So there are good and bad messages in what you've seen to date. When it comes to the market itself, be very careful in accepting price predictions, not least those offered by a government. We don't have anything like $20 per tonne of carbon today in Europe. It's about 24.5 euros. And even though our business looks at this every day and tries to make sense of how the market moves, we'd be very, very bold to say that the figure would be $20, 20 euros in 2020. It's much better to set a long-term target, commit to it, and then let the market pick the price. On trade matters, I have some experience in that part of the law as well, having represented countries in the WTO, and my colleague here, Dr. Monica Araya, from Climate Change Capital, also had many years' experience working on trade matters, and I think if you asked her, should have the same view as I. Be very careful with using trade measures. If you use trade barriers to protect your own domestic measures, it's very hard to remain pure. Everybody's implicated in the climate change debate, everybody's implicated in the solutions. Nobody comes out of the past 200 years in the developed world with any great honour, even though it wasn't our fault that we created the climate change problem. We didn't feel guilty about it, but it's extremely difficult to put up trade barriers and hold to them. What you tend to find is actually the competitiveness effects are small. Even here, with a natural resource-based export economy, you will not find very large amounts of competitiveness effect. And if you do, then I think you should switch debate away from government intervention at the trade level, at the border, towards business leadership. You should ask the leaders of the industries who are currently lobbying for special favours what sort of leader it is that says, we're going to leave the country because we can't fulfill our obligation to deliver the public good by reducing our emissions. So we're going to go to another territory and contribute to the same problem that we as Australian citizens are going to face here. Because it doesn't matter where the ton of carbon goes up or indeed where it comes down. So if you take your business offshore to escape regulation, you aren't escaping your responsibility for the problem. So I don't think it's much leadership in business to promote that kind of action, and there should be a peer group of business leaders looking hard at each other saying, actually, we won't do that. What we'll do is we'll cope, we'll adjust, like good business leaders, we'll make money from the change. And many people in that sector or those sectors have strong balance sheets and they can afford to invest in the alternatives. At Climate Change Capital, what we try to do is look at the whole range of asset classes affected by climate change, both the physical responses and the policy response. So we're a rapidly growing company. We started 5 years ago, almost exactly this month, with 3 of us. We're now 155. We have 34 people in Beijing. We started with a small advisory business, which is still going and bigger now. We now have $1.7 billion under management. And it's all focused on specific strategies for reducing greenhouse gas emissions, principally through our largest fund, which is a carbon fund driven entirely by policy, dependent upon the outcome of international negotiations, at least up until 2012, but now looking increasingly for carbon value investments. And whether it's emission reductions from efficiency, or through renewables, or through finding ways to destroy industrial gases, there is value to be obtained in the application of sometimes quite simple technologies in countries like China, where, for the time being, most of our investment is going. I think we've invested something like $750 million in the last 18 months in China reducing emissions, just because of the Kyoto Protocol and the European Emissions Trading Scheme, and some demand coming from Japan. But we aren't betting the house on the carbon market. We have other strategies, a private equity fund focused on clean technology, a property fund just reached its first closing. We have strategies that are now coming forward, a new fund on listed equities, and a strategy we're working on hard with some concern, which is difficult, is how to invest scale capital in land management, forestry, focusing on water resources in particular, where Australia is a very attractive place for investment in, we think, in due course. So the business is trying to concentrate knowledge on the relationship between policy, finance and technology. It's an optimistic entrepreneurial business. The opportunity that we see is scalable, so each fund that we bring forward has to be both replicable and scalable. We think we can see great opportunity within the Chinese market based upon policy changes which are happening there, not just the external influence through the Kyoto Protocol, but through domestic programs driven by leadership at the top. Everywhere you look in China there is paradox. You can't seriously confront the climate change issue without looking hard at coal, and of course there are coal-fired power stations being built every week in China, but there are also about 80 power stations of the older, crankier type that have been shut down in the last year. China is almost certainly going to be the largest renewable energy market in the world, and we are almost certainly going to be importing technology that has been made there. So don't think of them as recipients of our technology, but the source of opportunity for investment in clean tech as well. We've just bought a business in the States and we're interested in expanding there because we can see policy change on the horizon. We know full well that the president's election will create a very different sort of leadership in the White House, at least on the global aspects of the climate change issue. and there's much legislation in the mix in Congress which will come forward roughly in the same time frame as the Australian legislation, perhaps a little bit behind, but it's likely that in due course you will have very substantial demand for emission reductions in all the big markets in the world, which means that for you as institutional investors, long-term investors, there will be a shift in value within most of the asset classes that concern you. Listed equities, property, and certainly private equity. You will find that the carbon price in these big markets and policy directions will affect the value of your assets now and into the future. So, given our business's wholehearted commitment to dealing with climate change in a positive and optimistic way, we are still dependent in some respect upon governments acting rationally in the face of this very clear scientific evidence. And that means policy making of high quality. It's not at all easy to make the interventions that need to be made and still stay on the right side of economic growth. But the carbon market is one way in which it is possible to align public interest in reducing greenhouse gas emissions with private gain from the sensible and rational allocation of resources. That's one element of public policy making that shows great promise, but it'd be silly to rely exclusively upon it. And we think it's important that governments can experiment with a range of public policies and have good feedback from how those policies are working. And one of the best ways to get to know the effect of their policies is to speak closely to the investment community. I was pleased to see in the last presentation that that's something the industry is doing here. The Carbon Disclosure Project, in large part, wants to organise behaviour so that the industry is well informed and can make good judgments about value shifting. But equally, sometimes one has to intervene very specifically on measures that you will know will make a material difference to how you discharge your fiduciary responsibilities. It's obvious to me, having looked at this issue over 20 years now, that to act responsibly within your fiduciary responsibilities, you have to take into account the climate change issue. But if you find that there are barriers to doing what you know is rational that come from poor public policy, then equally it's your duty to make it plain what needs to change. That's the best way of looking after your beneficiaries over the longer term. And we have got investment in our company and in our funds from people just like you who have made those decisions in Europe. USS is an example from the UK, ABP from the Netherlands, PGGM also from the Netherlands. So in sum, what I'm suggesting to you is that when you take the scale of the problem, look at the systemic risk that it poses, look at the scale of opportunity in the roughly $21 trillion that's got to be spent on updating our energy infrastructure and providing for new energy demand around the world, see that investment over the next decades as necessarily involving the gradual reduction of CO2 emissions, even in economies like China and India, as well as, of course, in the US and Europe and here, that bit by bit, your interaction with public policymakers and the new innovators that are coming forward in technology will enable you to channel investment into creating wealth worth having. That it won't just be a shop in London with an idealistic aim and some very determined staff that grabs hold of this theme. But there'll be many others, not least in this market, who will be delighted to work with you to find ways of putting your investment to work so that we deal with the climate change problem and live well and find no particular hardship in accommodating the changes that must be made. I'm not suggesting that it's all going to be easy, or there won't be difficulties in transition, but I'm absolutely confident that there is sufficient capital in the world, there's sufficient ingenuity and innovation available in our technology creators and developers, and that we have the capacity as a business community in particular to adapt to these changes and to prosper having made them. So I commend those ideas to you. I'm happy to answer questions as we go along and look forward to the rest of the conference. Thank you.
I'm going wanted to talk about what climate change means for superannuation funds in terms of their total investment portfolio. I guess from an investment consultant's perspective. I'm going to be covering a couple of things here. Briefly, the economic impact of climate change, to put some context around this being an investment issue. What are the big issues for super funds to consider, and what does it mean for some specific asset classes, just for a bit more detail. So with regards to the economic impact, I've got here a bit of a comic strip from GetUp's advertising, I guess, of the Garnaut findings regarding the impact on the Australian economy of climate change, which it estimated as being quite significant. And there's other studies as well, the Stern Report and others, that have shown climate change is expected to be a significant negative impact on economic growth over time. I'm not going to go into all the details of the economic studies. Some of them, have been around for some time. But just to sum up kind of what we find from Frontier as being important in that work. One is a view that climate change will have a significant and negative impact on economic growth. Secondly, the response that our government and governments around the world make to climate change will also have costs, but hopefully the overall impact on climate change, or the overall impact on economic growth will be less than if we did nothing. And putting a price on carbon emissions won't have an equal impact on all parts of the economy. There will be winners and losers, and when we think about all of these issues together, it adds up to climate change being a meaningful investment issue. So what's it mean for super funds? Well, firstly is to recognise this as a systemic issue across asset classes, across investment portfolios that are being held by superannuation funds today, and shouldn't be ignored. We see it as risks and opportunities, as I think the previous panel did as well. In terms of risks, I think it's important to say this is clearly a very complicated issue. There's a lot of uncertainty in terms of how climate change will play out and what our response will be, how that will play out, what the first and second order and third order effects will be. Superannuation funds outsource a lot of the detail of the investment decision to fund managers, and this really places the burden of assessing the impact of climate change on fund managers, and that's a big ask. The work that we do at Frontier, we meet with a lot of fund managers day to day in a lot of asset classes, and our work has really found that it's becoming more of an issue that's considered. Certainly it's got some traction, but there's a lot more that needs to be done, and there are still firms out there that are kind of questioning the science, and that's a real worry to us. And given we're not there yet in terms of it really being an accepted part of investment decision making, we do think everyone needs to be involved in the investment process, and certainly a lot of super funds have been strong advocates and supporters of looking at climate change issues. We think as investment consultants we need to be increasing the dialogue with fund managers, and certainly the broking community has been quite active as well, which is good. We think in terms of the view that climate change isn't an investment issue is a strange one, when the argument is given that there isn't certainty. Certainly there isn't much certainty. There's more information now on what our trading scheme might be for carbon, but there's still a lot of uncertainty in terms of what it means for individual investments. To us, that's not that different to any other investment risk. No one goes in making an investment decision knowing everything. It's about making intelligent judgments about what we don't know, and being on average on the right side of the decision. So climate change doesn't seem, from the outside, I guess, much different to being part of that process. With regards to opportunities, there will be opportunities, we think, to make money from investing in activities that seek to respond to climate change. And certainly, there's a sense that there'll be a need for a lot of capital to respond to climate change, and superannuation funds, are well placed to be a part of that if they are good investment opportunities. And that's certainly a point, we like to stress, it's got to have overall investment merit. Something can be a great response to climate change, but unfortunately not a good investment. So obviously all the usual kind of, issues around what's a good investment and what's not still apply. Just on to talking about some specific asset classes. I focused on the equity-related ones really because this is an economic growth issue, but one could kind of extend some thoughts to debt if one wanted. And I'm certainly covering off on a lot of superannuation fund portfolios from a percentage perspective. So listed equities first. When I thought about this, it occurred to me, some of the decisions here aren't made by fund managers. It's made in asset allocation. We make decisions about Australian equities versus international equities. We make decisions about emerging market versus developed market splits. And could climate change be an issue where that comes into play when making those decisions? I think it's tough now, but I think we can certainly look at individual countries and say, are they better prepared or not? Do they have better economic support to make the changes now and bear the costs? And some countries, unfortunately, are more exposed, I guess, to the physical aspects of climate change, which is unfortunate in itself, and is also an investment, risk. But most of the decision, as I said, is outsourced to fund managers with listed equities. And we're really looking for things in investment decisions with regards to climate change being considered. And we do recognise a lot of the impact at the stock level is driven by, the government and regulatory response to climate change. But, things need to be assessed about industry dynamics, how a company responds, is its management up to it, whether consumers are willing to take on costs and what the experience has been so far. There's certainly, analysis that could be done at the qualitative and quantitative level, I think, at this point. And it'll certainly, I guess, be a bit easier when we have a price of carbon, but there's work to be done now. We've done some ESG assessment of Australian equity managers, which I think we've talked about before, is environmental, social and governance, and the E bit, I guess, is climate change in a lot of people's minds, and in terms of being part of the investment process, it's the area that's been worked on most now, but it's needing a bit more. Going on to private equity, a lot of the risks, it's the same as listed equities, it's just they're private and they get realised in a different way. But I think private equity is also important from an opportunity perspective. The clean tech industry is well suited to the private equity model, and particularly the venture capital model in terms of where it belongs in a company life cycle. Clean tech's now the 5th largest venture capital group. It's predicted to grow very strongly. And we're seeing it emerge both in terms of clean tech managers and clean tech fund of funds, but also within normal venture portfolios and normal private equity portfolios. So super funds may find, even if they don't allocate to clean tech managers, they will be seeing some clean tech be emerging in their private equity portfolios. And that's, when we think about at a total portfolio level, what our exposure is to the risks of climate change, this is I guess you could view as a good offset or a hedge, though perhaps not very proportionally weighted. The concern that we do have with clean tech, I guess, is the risk of a bubble situation. Sometimes money comes before, there's things to invest, and the timing doesn't quite work out. And it's certainly, as I said at the start, really important that the normal investment decision-making factors are abided to in this area. You don't make money by paying too much for something that is sought after. Infrastructure is an interesting one because, with economic infrastructure, there's always been kind of regulatory and usage risks, and climate change really adds to that. And I think you can look at a lot of categories of infrastructure and see that climate change and our response to climate change could have an impact. In the transport area, you can look at airports and toll roads and say, well, usage may go down. Certainly the cost of building a new toll road will go up. And what does that mean? I think managers need to be looking at what that means for investments and investment returns. In terms of energy, that's the most, I guess, obvious one. Looking at portfolios, one needs to be thinking, well, are there assets in there that are going to become redundant, and how are investors going to be treated in an asset that's being wound down? There's also an issue in a liquid and long-term asset class when you're looking at transitional investments, transitional energy sources. Don't want to be going into a 30-year investment when it's something that really has only got legs for 10 years. And I think, again, this is hard, but managers need to be looking at the extent to which things will play out in the future. And it actually goes to the kind of proven technology versus unproven technology distinction, I guess, between infrastructure and clean tech. And we expect things will probably emerge in infrastructure that seek to respond to climate change, but may be less proven or less long-term. And that may not be a bad thing as long as it's invested in the appropriate manner and structure. But certainly, investors need to be aware of that and be cognizant. And I've mentioned timber there because that's obviously not infrastructure, but it is a good one in terms of when we think about climate change. Lastly, on property, this is a bit of a different one because property in Australia at least has already kind of responded to climate change in a way by having some industry standards, some ratings that they apply to energy efficiency of buildings. The Australian Building Greenhouse Rating is one, and that's really created some transparency when we look at, say, commercial property as to what is an energy efficient building versus what's not. And there's been a number of them come onto market. Certainly we've seen not a clear price impact. Those buildings don't appear to have got higher rents because they are energy efficient and have a high star. They do appear to be in demand, and we expect companies and governments more to say, well, we want to be in a low energy efficient building, high energy efficient building, because that gets their own footprint down. So we do think pricing benefits will emerge. It may be that the property markets of recent have had different issues that have kind of swamped the effect. And there's also a clear risk of assets becoming obsolete, and I think portfolios need to be looked at carefully. When we look at property portfolios and have begun to monitor the rating standards within portfolios, it can be quite frightening. There are portfolios that have a lot of one-star properties, and what that means for the long term and how managers deal with that is important for returns, because it may well become a meaningful issue on returns. In terms of how we deal with that, there's risks to upgrading as well. If you suddenly say, well, right, I'm going to make this property more energy efficient and upgrade it, it's a really costly process. It obviously makes sense to do it when you need to do a refurbishment, but some properties, it may not be worth the cost from an investment perspective. So there's a lot of things to monitor there with property investments. And it's interesting that that industry becoming more transparent has kind of brought forward the risks for existing investment portfolios because that transparency is there. In terms of conclusions, just to recap, climate change is a portfolio-wide issue. We see there's risks and opportunities. I think we all need to work within the investment process to make sure this issue is being considered. There's a lot of specialist products beginning to emerge that we're seeing, and they're probably got the leading edge in terms of climate change understanding and the impacts on companies. But we really do think this needs to be mainstreamed as an issue and it needs to be considered. So the risk is dealt with across superannuation fund portfolios.
What I'd like to cover today is looking at the physical impacts of climate change, because I think increasingly that is another area of us as investors need to start getting a grasp of. Because climate change or responding to climate change, doing nothing is not a cost-free option for us as investors. And it certainly isn't going to be cost-free if we aim at 550 parts per million, or as James identified, 450 parts per million. So it's an issue that we need to understand how it's going to impact our investments, and that's the physical issues that we're going to be addressing. To give an indication of the quantum of that, the Australian Bureau of Statistics did an analysis of what the impact of the 2002-2003 drought had on Australia's GDP, and they estimated it to be 0.7%. Now that was 2002-2003 drought. We then proceeded to have another 3 and now 4 years of drought with the equivalent impact, if not more, impact on Australia's GDP. So what I'd like to do is, share with you in the next 15 minutes what we've seen looking at our portfolios, and they're primarily equity portfolios, but I think you'll see some issues which apply to both property and infrastructure, on what the impact might be on investment value from looking at the physical impacts of climate change. Well, the first thing is, what are we sort of expecting generally from the whole idea of physical impacts of climate change? Well, the first one we're going to see is an increase in volatility or variability in the weather, and particularly in extreme weather, extreme storm events. And that's the thing we're probably going to see first, and that's probably when you see the popular press people saying Katrina is due to climate change, Cyclone Larry is due to climate change. Whether they are or they aren't, probably not worth having too much of a discussion on, but what it is an indication of is that they're the sorts of extremes that we're seeing that you'd expect climate change to bring on. The other one operates on a much more longer term time frame, and that is some fundamental changes to the climate. And they have some more fundamental issues to do with whole industries and sectors, which I'll cover. So in sort of summary, how do those two things manifest themselves in investments and in terms of value? Well, the first thing I think you find when you're looking at the variability of weather and the climate is you end up having an increase in variability in earnings of companies, an increase in volatility. And that volatility ends up being embedded into the value of companies. And generally, the greater the volatility, the decrease in value of a company. You end up with increased business risk, which has some implications. You have a range of increase in costs, particularly insurance and maintenance costs, particularly in the area of infrastructure. We have some decrease in property values, and in some cases you have some fundamental questions about the viability of the industry. So, what I'd like to do is just fill out on those sort of four key things and just give you examples how we've seen over the last couple of years examples of that. So what would you expect from climate change? Well, the things that get the big news are the sudden changes, the big weather events. And since we're in northern Queensland, there's some photos of Cyclone Larry from a couple of years ago. Now, we probably all felt the impact of that as what was known as the banana inflation, the radical increase or significant increase in the cost of bananas from whatever it was, $2.99 a kilo to $12.99, an outrage if we were at that particular thing. But I think those sorts of things are reflected in a much more subtle way, or sometimes not so subtle way when you come to look at equity markets. This is the impact of climate on IAGs. And IAG share prices is a sad tale. But what I'd like to bring to your attention is what the impact of some of those big storm events have had on IAG share price. And how, as investors, it's obviously impacting share price, but also from an active investor, if I can pick up on those issues, an opportunity for us as an active equity manager to get some alpha out of that. So you see that back in 2008, that's about 2007, AIG announced the losses of some storm events, and the share price responded downward as a result of that. Carried along, and then we had the Newcastle storms, which is one of the second or third highest storm events we've had in terms of insurance claim. And the share price, strangely enough, didn't respond significantly to that. But look at the change to the IAG share price once the announcements of the losses associated. And then along came the Sydney storm events about 9 months later. The market responded to that, and again, even the market didn't value that correctly, because when IAG actually announced its losses associated with the Sydney storm events, downweight the share price again. So that gives you a sort of a sense about how these sorts of things like storm events might impact the insurance company. But it's not just the insurance companies that get impacted by these radical storm events or significant storm events. This is a photo of a coal mine in Queensland, central Queensland. Central Queensland seems to have quite a lot of those. And this also is a photo of a coal mine. Or maybe it's not a coal mine, but more a rather large swimming pool. And that's a photo of one of the coal mines in central Queensland after the floods that they had. And it's very hard to get a sense of the proportion of that. I don't know if you've seen photos of those big yellow Tonka toys, dump trucks that they use on mines. And normally the wheels are bigger than the people. Well, that thing that you see there, the drag line, makes those big yellow trucks look even small. And each bit of kit, well, that thing there, costs millions of dollars, and it's now sitting under meters and meters of water. There's a similar photo of this of ERI's uranium mine up in Kakadu. And again, if you want to have a look at the event which caused that particular flooding of that particular mine and what happened to ERI's share price as a result of that, again, you see the impact of the physical impact of climate change, or rather storm events, on the equity market, such as this. And there are other examples of this. So let's have a look at some of the other issues. What I'm going to do now is give you a sense of just some of the things we've seen looking at the volatility of earnings as associated with the variability in the weather. It seems strange to be talking about the weather, but it is actually has some significant impacts. And we've seen it in a couple of key industries. One is the energy industry, where in particular people who sell gas into Victoria, critical for their business is the number of heating days, or degree heating days that they have in terms of their demand. And what happened is that there was a number of warm winters in Melbourne, and their earnings for that particular business change significantly. And that's what you're going to expect. You're going to have these uncertainties about what the business is, what's going to drive the underlying business of those sorts of things. On the converse, some of the hot days that we've seen, certainly in South Australia, has been very significant for the earnings of some of the power station operators in the South Australian market. And that has been a great bonus for them. It doesn't actually need to be too many days for a significant earnings upgrade for those guys, given what happens to the electricity share price under hot weather conditions. But similarly, the downside for that is the energy retailers, electricity retailers, were really squeezed by that, and what was key for them was how well they'd actually set up their hedging books to deal with the volatility in the electricity market, all because of how hot the weather was and for how many days in what part of Australia. Similarly, it's probably not surprising you see that volatility also in some of the agricultural companies and some of the fertiliser companies who have to respond to the way the farmers responded to drought. And also similarly, or not similarly, surprisingly even the retailers have had to respond to unusually warm April, for example, because April is usually the time of the year where they have their winter sales. And certainly, I think last year and the year before, certainly in Sydney, because we had a warm April, completely turned their marketing and sales approach for their winter sales completely upside down, because people are saying, well, it's still having a balmy sort of autumn here, what do I need to be thinking about winter sales? So the challenge is those issues are real for companies that we invest in. The challenge is how do we identify the investment implications, and I guess that's what we've been looking. If we look at property, another issue, and again we'll keep on the Queensland theme. This is a graph of cans, unfortunately we all just flew into, and it's a graph of cans, and the dark blue are the current flood 100-year flood predictions, or 50-year flood predictions, I think, for the Cairns area. The light blue is where they think that will change by 2050. So first thing you clearly see is a whole more area of Cairns is now going to be flood prone. The critical issue is what is that going to do to the impact of the value of those properties in that particular area. Now I've chosen Cairns because we're in North Queensland. You can do a whole range of other areas, the Gold Coast, and a whole range of other low-lying areas, and you'll be able to get you'll actually get the same sort of impact. But I think what's interesting about this particular aspect of physical impact of climate change is it reflects you don't actually need the actual physical event to occur, because those property prices will be impacted when the market says there's been a change in the flood conditions of this area of Cairns. Once the market says, hey, this area is floodplain, I'm not going to pay as much, you don't need the flood to demonstrate the issue, just the market needs to understand that. And so the question is, how will those people who own those properties, or us as investors who own those properties, deal with that? How long do you hold on to those properties, wondering when the market's going to own up or understand these particular implications? For some industries, it's a more fundamental issue. I think Ian, in his introduction this morning, talked about the headline in the Courier Mail where he talked when responding to Ross Garner's proposed targets, and the headline is "Climate Target to Kill Reef." Imagine what that will do to the tourism industry in this particular area here. Imagine what that does to the airlines who fly the tourists in this particular part of Queensland. But there are some other issues, and I've picked on a couple of kind of more different ones just to give you a feel for the diversity of how this impact might be. One is the forestry sector. I picked that for two reasons. One is a lot of people see this as a real positive sector, and I generally agree with that. But again, the devil is in the detail. Some of our eucalyptus trees are incredibly sensitive to changes in the climate. Now, 1 degree is not very much, but a quarter of our eucalyptus trees will need to live within a sensitive to a 1 degree change in the mean temperature. 25% of them are also sensitive to 20% changes in mean rainfall. So again, if you're thinking about forestry investments, what sort of trees and how robust they are they going to be over a 20, 25, 30-year time frame, which is what you're looking at when you're looking at the investments of those sorts of things. The other key issue for that particular information is, you probably remember that stat which talked about the importance of land use change with regard to Australia's greenhouse gas emissions. I think the impact on forestry and land use change, just as a result of the physical impact, it's going to be an interesting issue for us as Australians to deal with, because it probably means we're going to get some unintended emissions as a result of just our forests naturally responding to climate change because of their sensitivity to temperature. Another one which is probably close to many of your hearts, or close to my heart, is the viticulture industry and the wine industry, obviously. And again, the impact of what the physical impacts, the longer term physical impacts will be of the weather on the wine industry, particularly wine quality, yield, but also particularly quality, because that's the thing that Australian wine industry is trying to differentiate itself in the international market. And if wine quality goes down, again you're starting to raise questions about what is your competitive advantage within the increasingly competitive international market. And there are other, just in whole terms of the types of grapes you can grow in certain particular areas due to the climate changing. The other one is there's some flow-on effects as well from these physical weather change related, climate change related impacts of climate change, and that is the whole issue to do with water. And I think one of the other speakers touched on this. And I think water, as a result, in its own right, but also as a result of climate change, is going to be an issue almost as big as the whole discussion we're having about emissions trading, about where do we get the value for our water. But I think we've already seen it with regard to the impact it's had on Queensland electricity generators. So there's been an issue in Victoria and the Victorian ground coal generators. But I think increasingly it is going to be an issue about, is that the best thing to do with our water? And it's certainly an issue that is a major constraint for a lot of mining investment. But in one respect, that's actually where we get most of our value from our water, which might seem a bit strange. And unfortunately, the agricultural sector, in terms of value add per megalitre of water used, is actually at the down sort of at the much smaller end than it is for electricity generation, mining, or processing. So again, I think that has some real interesting implications going forward about how companies are structuring themselves to deal with those sorts of things, as increasingly water becomes, as much as the debate, if it's not already, as the discussion we're having about climate reduction. I think I'll call it the ETS because I think it's a lot easier to say. So I'll leave it there, but what I'd like to do is to say, just give you an indication of how much the physical impacts of climate change are going to affect your investments. And I try to give you an indication by covering a range of different sectors which you might have thought would be impacted by the physical impacts of just what it might be. And I guess the range of impacts they might be, the range of things you need to think about. It's interesting that it will apply to a range of what we would normally consider as part of the equity managers, the insurance, the mining, the energy infrastructure, but also some of your other important asset classes, certainly property and infrastructure, and increasingly some of the alternative assets that have been talked about in terms of agriculture-related investments. The challenge for us is to understand the assessment of the costs and the risks and how they manifest themselves, and I guess from an active manager, how we can get that alpha out of looking at those particular issues, but also particularly looking at the investment opportunity more broadly. The other challenge is, which I haven't touched on, is probably another discussion all in its own right, is that those physical impacts will require adaptation for us to deal with, especially in the area of infrastructure. And there's certainly a whole range of costs there in the infrastructure sector, which we'll need to address, whether it be toll roads, whether it be airports, and certainly with regard to electricity generation, that people will need to start thinking about in terms of added costs which are currently not in their business model.